Hello and welcome back to Bunnex Investment Group, and today we are going to be discussing a very simple strategy that can be used on gold. And this strategy is basically called the TDI strategy, or the Traders Dynamic Index strategy. But before we jump into the whole video, please make sure to check out our free signals Telegram channel. The link is in the description below. If you haven't done so, please hit that subscribe button and the notification bell icon so that you will not miss any of our videos. So without wasting much of your time, the TDI or Traders Dynamic Index is actually a very common indicator within the Forex market. The first thing that you have to do on the TDI is to see the RSI line piercing or bouncing on the overbought or oversold line. As you know that the TDI is actually a derivation of the RSI line. It is the overbought as well as the oversold line. On the overbought, we will usually use the values of 60 to 72. So I will be using 70. And on the oversold, we'll be using values of 25 to 32. So I'll be using 30. Within these lines, there will be a line called the RSI line or the TDI line. It's basically a line that actually measures the relative strength index of the price market. So the setups or the only conditions that we have to take trades is to see the RSI line piercing through the overbought and then coming back on the H1 time frame for looking at sell signals, or the RSI line piercing through to look for buy signals, or the next case is to see the RSI line bouncing on 70 or bouncing on 30 to look for buy signals in this case. So these are the zones that we'll be looking for on the H1 time frame to see price behaving in this manner. The next step after seeing price behaving in this manner is to go on the M15 time frame to look for a setup. We have to go on the M15 time frame to look for a setup. So which setups do we look for? We look for M's of this manner, which we call the extended M's, or the normal M's, or M's which looks like this, and the inverse is true, whereby we look for W's of this manner, of the normal W. Right, these are some of the setups that we'll be looking for. In addition, we'll be looking for head and shoulders setups, the inverted head and shoulder as well of this kind. So on these M's and W's, we will have to confirm their existence using the TDI on that M15 time frame using the divergence system. I'll show you everything on the charts. So without wasting much of your time, let's jump over the charts and see how everything goes. So this is the TDI on H1 time frame. And this TDI, the cases that we were talking about are these ones, whereby, as you can see, the price line is at 60 something and at 32. So what we'll be waiting for on the H1 time frame is to see price piercing the 60s, the overbought line, or touching the overbought line, or piercing the oversold line, or touching the oversold line. After seeing this scenario, we will have to go on the M15 time frame to look for the setups that we have been talking about in the slides, right? So basically, these are the points that we will be looking for on the H1 time frame, whereby the RSI line, which is in green, will be bouncing or piercing the overbought or oversold line. After that, we will have to go on the M15 time frame to look for the setups that we've been discussing. So without wasting much of your time, we are going to have a quick back test of how this strategy behaves. So the first thing that you have to note is our stop loss on this strategy. When it is being applied on gold, you have to put it at 150 pips. As we all know that gold is a high pip value as well as a compressed pip asset. We'll have to use several pips as our profit, as our targets, or as our stop loss. So on the stop loss, we have to apply 150 pips, and on the profit targets, we will have to apply 300 pips. This gives us a risk to reward ratio of 2:1, and you can also increase it to 3:1 depending on your choice. Right? So I have already marked the points whereby price actually pierced the overbought or the oversold line on the H1 time frame. As you can see, I have been marking this one was the point where price pierced the oversold line, and I've put these rectangles so that it will be easier for us to go through the back test. And when going through the back test, we'll be using the M15 time frame, because as I said earlier on that we will be trading from the M15 time frame, and we'll be looking to have our entries after candle closure below or above the 13 EMA. That's the only confirmation we have, in addition to the divergence or convergence of the TDI and the price line. So what is divergence before we go on the M15 time frame? Divergence is basically the dropping of price or the rising of price in an opposite manner to the RSI line. As you can see here, the price is actually showing us that they are rising, but on the RSI line, price is actually showing us that they are dropping. That's basically what divergence means. So let's go on the M15 time frame and backtest only those trades that were going to be winners. So I'm going to go back a little further where we will start to look for trades, and on this strategy you are probably going to get 1 or 2 signals on gold per week, and it's actually advised for you to keep on backtesting in the historical chart data. Right, so we are going to start at this point, which was in January 2021, to see how everything went. As you can see, price is actually going up, but on the TDI, price is actually going down. We can actually use the trend line to see this clearly. As you can see, price is going down, it's going up, and candlestick closure after the M has been determined is where we get in. So in this scenario, our M was of this sort. As we said that we have different types of M's, and it was the one with an extended second leg. This one was the extended second leg, and we were going to enter after candlestick closure below 13, our stop loss at 150, and our target at 300 pips. Whenever we reach 150 pips in profit, we have to move the stop loss into profit or at entry. And at this point, we can see that we had the head and shoulders, which is inverted. This one was the shoulder, the head, and the shoulder, meaning that our entry was going to be at this point. Try to measure the pips that we are going to earn in profit before it came back to entry. So therefore, we had 250 pips at this point, and the price decided to come back to our entry price. Therefore, we were taken out. We had another point here that we determined on the H1 time frame, and we were actually looking to get a second leg so that we could get an entry, but the setup was not nameable. This is not nameable according to our rules. So the first thing in backtesting is not to lie to yourself you have to be transparent as much as you can. At this point, you can see that we had a rise of price to this point, then a drop, then a rise again. And on the TDI, this actually shows that the relative strength index is showing us that the US dollar is weakening against gold, is actually increasing value against gold. Therefore, this was a valid setup whereby we were going to enter it at 13 candlestick closure below the 13 EMA. This was the first scenario. Or the next scenario, if you were attentive to the price movement, you can see that we had a shoulder, we had another shoulder, and we are going to enter a candlestick closure below the 13 EMA. And let's go on another zone. From this zone, we had the first leg here and the second leg here. Therefore, our entry was going to be within this choppiness behavior, because that is where our candlestick closed below the 13 EMA, and we were definitely going to hit our target of 300 pips. At this point, we had this first leg, and we were expecting the second leg, which was then issued and confirmed on the TDI, and our entry was going to be here, and then our target was going to be hit. We had another scenario here, the first leg and the second leg, but we might have seen this as an M. As you can see, it is a clear first leg, a clear second leg, and on the TDI there is enough divergence, and on that we were going to enter at candlestick closure below 13. Let's see if our stop loss was going to survive. As you can see, this spike actually left at 131 pips, and our 150 was way above. Therefore, this trade was going to remain live, and our target was going to be hit. Trading is all about patience, and you have to be patient for everything to play out. We've marked this zone on the H1 time frame, and we had the shoulder, the head, and another shoulder, and from this point we could enter our buy position, and we were going to hit our target. Then we had the first leg and the second leg. As you can see, the first leg is actually higher than the second leg, therefore divergence is confirmed, and our entry at candlestick closure below 13 was going to give us our target. At this point, we did not have a NMAP setup. As you can see, even the TDI is not confirming anything or rise or drop in the relative strength index. Therefore, this was not a trade. At this point, we now had reached at that point where we met the setup whereby we have the first leg higher than the second leg, whilst the relative strength index is actually showing that the strength is dropping of gold. Therefore, we could enter our sell at candlestick closure below 13 EMA and reach our target. In this point, we had the first leg and the second leg. Yes, it might be difficult to see these legs, but I advise to put the line chart so that it will be easier for you to see the spike legs. As you can see, the first part was this and the second part was this, and the TDI was actually confirming a rise in the strength, and that we were going to enter at candlestick closure above 13, and our target was going to be hit at this point. Here we had the head and shoulder, which was clear. As you can see, this is the shoulder, the head, the shoulder, and from there we're going to enter at this point, and our target was going to be reached. So basically, this is what you'll be looking for. You will be looking for the trades that have been derived from the H1 time frame, and you have to keep on backtesting so that you have confidence with this strategy. It's not about winning every trade, but it's about having larger wins than losses. With that being said, we come to the end of this video, and don't forget to check out our free signals Telegram channel. The link is down below.